What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing episode. In this episode we're going to talk about my top 5 dividend paying stocks my top 5 dividend paying stocks right here in the UK from the ftse 100. If you like what you see in this video, please hit the subscribe button. If you're brand new here, that'd be great. Or you can hit the like button to help out the YouTube algorithm and get this video out to far more people. That would be really appreciated by myself and the channel, obviously. So in this video we're going to talk about my top 5 picks for UK dividend paying stocks for this month. And these stocks, without further ado, are Shell, BP, Legal & General, GSK and Unilever. Now you should, as an investor, if you're not new to this, you will 100% know these companies. They've been around for a very long time. They're multinationals and they are worth billions and billions of pounds. I'm going to take you into the actual analysis of these stocks shortly in the application that I have. I just wanted to say that these companies are very strong, and they've got 2 of them at least are significantly beaten up right now because of the oil price crash. Unilever itself is down a little bit because of the uncertainty that is around due to the health crisis. Even though it produces a lot of cleaning products, it had balance sheet issues before this started. Legal & General is an insurer, so people aren't really sure where this crisis is going to end up. So obviously insurance companies could end up paying out an awful lot of money. So a lot of people have bailed out of these insurance companies just in case they have to pay a lot more than what they've actually got to pay out. And then last but not least, GSK is actually working on the vaccine potentially, or some drugs for this. There's a bit of a race going on, but is working on some vaccines for the health crisis and working on helping out as best it can in terms of applying the science to help defeat the health crisis that we are all experiencing right now, not just here in the UK but across Europe and the rest of the world. And any company that is doing that is bound to do slightly better than others at the moment. Just something that I would say about GSK is it is working on a split within itself at the moment. It's going to create 2 companies alongside Pfizer, who's also going to, I'll get more into this during the analysis, but it's actually going to siphon off its over-the-counter products into a whole different company. So Pfizer's going to do exactly the same, over-the-counter products into one company. GSK is going to do the same, such as its toothpaste and its mouthwash, etc. And they're going to amalgamate that in one company and create that into a whole new company. And that is what is causing some slight nervousness around these companies' share price at the moment. That being said, let's actually get into the analysis. I'll catch you in there. Catch you later. What's going on, dividend chasers? Thank you very much for joining me in the next part of this video. In the actual analysis side of the video, it is absolutely great to have you here. So we are, just a quick recap of who we're going to cover here. We have Royal Dutch Shell, we have BP, we have Unilever, Legal & General and GlaxoSmithKline, also known as GSK. Now we're going to start this one off with Royal Dutch Shell. Now you guys will know this company. Everybody knows the little Shell logo from fueling their car. This is a company brand that is instantly recognisable and everybody will recognise it across the world. has been absolutely battered lately, thank you to the oil crisis, the health crisis, keeping people at home, and the oil price war that has hit this stock two times over. Right, just a few facts and figures for you here. We have the ticker name is RDSB. They have a market cap of 116 billion. The yield is currently 11.31%. The revenue is 318 billion. Earnings per share £2.75. They're roughly trading today at £13.40. They've been down to below £10 at one stage, I believe. They dropped right down. In fact, that was fairly recently. Let me just take us there. Yeah, they dropped down to £9.10, which is an absolute steal for this company, and have actually been up at a really decent price of £26. And Simply Wall Street actually has this company undervalued by about £30. It thinks that this company will eventually be worth £45 a share. And as you can see, that yield is absolutely whopping right now. And their net income so far has been 15.84 billion. As you can see, this company is an absolute cash cow. It has paid its dividend. And this is no small feat, since World War II. So that is well over 50 years it's been paying for its dividend. It may not be a dividend grower. The dividends have remained the same for quite a while now. Growth's been sluggish at below 1%. However, one thing that you can bank on with this company is it will pay its dividend. It has done so far, and it will endeavour to do so as best that it can. I did read a report recently, not here, that suggested that it had sold up to £9 billion worth of assets to make sure that it could cover its dividends in the short to medium term. And if I'm honest, like, just going slightly off piece here, away from the data, I wouldn't be so fussed if the company cut back on its dividend a little bit in the short term, cut it down to maybe 4 or 5%, just to make it sustainable again to what it is. Because I mean, as much as I'll enjoy an 11% dividend or 10% dividend, not at the cost of the company. Like, I would much rather the company kept going rather than practically bankrupted itself trying to pay out shareholders. The break even for this company, I actually did some other research. They reckoned that it needed oil to be, for now, without cost-cutting measures, $40 a barrel oil needed to be for this company to make profit. And at the moment, the oil price is more like $28 per barrel. So that means that the company at the moment is obviously making a little bit of a loss per barrel that it sorts out. However, with that being said, the short term and to the medium term, when this crisis actually passes, that should make the price of oil go back up, and then that should aid the Shell's revenue considerably, and that would be really good for us investors, because the share price will bounce back up then as well. The yield will come down, but we'll have bought in at such a ridiculous yield. We'll be laughing our way all the way to the next dividend payday and buying even more shares. That being said, it's time to move on to yet another oil company. I'm sorry that there's two oil companies in these recommendations, but I can't mention one without the other. They're so very similar, and they're both paying absolutely ridiculous yields at the moment. We're moving on to BP now, and I found out in the news today that BP has committed to its dividend in the short to medium term. So I would say at least the next 2 quarters are probably covered, and in which case that would allow the oil price to recover and the usage of the oil to recover too. So without further ado, we will talk about the analysis of BP. So the ticker is BP, surprise, surprise. They have a market cap of 59 billion. The current yield is 11.1%. Total revenue is 223 billion, should I say. The EPS is 0.58. They're trading today, or were trading today, at £3.2 a share. They have fallen a little bit below that, dropping at one stage to £2.36, which would have meant the yield was somewhere ridiculous, I think. And then at the top, their top end in the last 8 years or so, they've been up to about £5.50 a share. So there is still some capital growth to be had here, as well as the serious dividends you could earn from this company. Their net income was £4 billion. Now, with this company, it is not quite, I believe, as committed as Shell is to its dividend. Now, the reason I say that is it has cut it in the past, but the reason for that was because of Deepwater Horizon. Now, who knows if Shell suffered a significant crisis like Deepwater Horizon, whether they would be able to maintain their dividend or not. I doubt it, actually, so I might actually retract that further statement. However, the fact remains that Shell hasn't cut its dividend since World War II, but BP has had to due to Deepwater Horizon and before. And it is struggling with the dividend cover at the moment. Though they have said that they're going to maintain it, they need, according to my research, they need the oil price to be $45 to $50 per barrel to break even, and yet the price at the moment is $28 per barrel. So you don't need to be a mathematician to work out that, again, they're making a loss at the moment, and they need the oil price or usage or both to recover in the short to medium term to be able to maintain their cash flow and to be able to maintain their revenue and therefore pay dividends. This is another company I wouldn't mind seeing them cut their dividends down from the enormous 11% that it is to a more manageable 5% if it meant that the long-term health of the company survived better. But moving on away from the oil companies now, I just couldn't not include them with the ridiculous yield that they've got. And oil is an absolute necessity. We're going to need it for a lot longer yet. And both of these companies, both BP and Shell, have got one eye on the future and are actually investing in renewables, which I didn't actually know about until recently when I looked into it. Both of them are looking into liquefied gas, solar panels, and all sorts of renewable energy to make sure that they stay relevant and in the field even as we wean ourselves off oil for the future. I think that is a very shrewd move indeed. What I did notice is that ExxonMobil hasn't started doing this yet, and a lot of American oil companies haven't started doing this yet, so that could put BP and Shell at a significant advantage when this when the time comes that the world moves away from oil. That being said, I think there's still at least 10 or 20 years left in oil easily, with oil being as it is. So I don't think we're going to struggle anytime soon. Moving on, our next contender or customer or whatever you want to say is Unilever, ticker ULVR. Now, the odds are that you have, if you're from the UK or you're from Europe, you have a product from this company in your house, whether that be the Hellmann's mayonnaise, whether that be Lipton's iced tea, Vaseline, Persil dishwasher tablets, or clothing washing tablets, or washing up liquid, or Domestos toilet cleaner. That's just naming a couple of this company's wide range of products. Now, into the actual analysis of this company. The ticker is ULVR. They have a market cap of 106 billion, PE ratio of 17.36, revenue of 45 billion, earnings per share of £2.37, a nice healthy yield and a bit more sustainable yield, I would say, of 3.4%. 3.4%. Does pale in significance to the two previous customers that we've seen, but that is the nature of what this company hasn't suffered such a dent to the share price at the moment. It's currently trading at £41 per share. It has been down to about £36, I believe, at one stage, and has been all the way up at 53 in the past, back in September 2019, and it has a net income of 5.62 billion. So it's an absolute cash generator, this company. They can't go anywhere. You can't live at the moment without really using one of these companies' products. The health crisis is such that it is everybody's using home care products at home an awful lot more than they typically would be, so they're getting through them a lot more, especially if they want to clean the house, because of trying to get rid of basically, you know what, sound like a Harry Potter novel, but basically, yeah, saying you know, the healthcare crisis, people are trying to keep clean as best they can. That is good news in a weird way for this company. It's took a little bit of a battering due to the uncertainty around the crisis, and it did have some balance sheet issues before the crisis began, which has suppressed the share price down a little bit. But I think investors are starting to realise now that this company is on a sure footing. It's got a good net income, and people are using its products more than ever at the moment. Now, changing tack again, we are going to move on to Legal & General. So this is a massive insurance provider and asset management, investment and wealth management company. Well down share price wise at the moment, all the way down at £2.4 at the moment. Its ticker is LGN, has a market cap of 11.6 billion. The current yield is 9%. They've got revenue of 66 billion, earnings per share of 31 pence. And they have a net income of 1.83 billion, currently trading at £2.4p, as mentioned, being up after the general election last year to £3.20, when everybody was, well, investors were relieved that it wasn't going to be an incoming Labour government, shall we say, and it has been all the way down at £1.39 per share. An absolute bargain, I would say. This company tends to pay its dividends not quarterly, so the other three companies we've covered have been quarterly payers. This company pays annually, but tends to pay a interim payout as well. And that has been confirmed at the moment, even with the absolute hammering that the company has taken due to the insurance companies not really know, or investors not knowing how culpable insurance companies will be when the crisis finally peaks or peters out and we count the cost. Investors aren't sure about that, but Legal & General has committed to paying its next dividend and the last dividend of its 2019 year, and then moving forward we will see from there. So it's committed for the near term. It is a very ethical company, Legal & General. With the research that I did, they're very much about ethically investing their money in the right companies, producing and helping charities out as best they can. They have a lot of money coming into the company from the life insurance side of things, people that are going to pay anyway, and the asset management side of things, the people that are still wanting to invest their money right now. So their revenue stream is not as badly affected as oil will be in the short term, but as we move to the medium to longer term, when we count the cost, as I already mentioned, there could be a little bit more at risk. But that being said, they've committed to paying their dividends in the shorter term, and their stock price at the moment means they are at a significant discount, as already mentioned. And I would feel good, or I do feel good, about owning shares in this company. And then thank you for sticking with me, guys. We are there at the last stock, which is GSK, a big pharmaceutical company, a huge pharmaceutical company, should I say, one of the biggest in the UK, along with AstraZeneca. This is one of the companies that's working on a vaccine for the coronavirus. I didn't want to say it. The health crisis right now. So that being said, the race is on. Basically, if this company gets there first, they will gain massively. They will gain massively from it. But if they don't, they could therefore lag behind a little bit, or they could try and persevere with it themselves again. We don't really know, and pharmaceuticals is very well, is quite secretive with how they do things, so it's quite hard to tell until they announce it just how close that they are. Anyway, back to the analysis. The GSK, or GlaxoSmithKline, has the ticker symbol GSK, shocker. They have a market cap of 82.97 billion. Current yield is 4.84%. Total revenue 33.75 billion. Earnings per share of £1.33. Current price is £16.50 per share. It has been all the way down at £13.88 at one stage, and all the way up to £18.23. Have a net income of 4.68 billion, which means they are heavily profitable, of course. One thing I will say is they are working on a vaccine, as has been said. They are deeply invested and have protected rights on their other drugs that they're trying to bring to the market, especially in the HIV sector. And as you can read in this little blurb here, they're heavily involved in treating autoimmune diseases, rare diseases, stuff that will bring an awful lot of revenue to the company over the long term. There is some risk associated with this company at the moment, which was reflectant in the share price up until recently, and still is to a degree. I think people have started realising that due to the health crisis, that the company does stand to potentially benefit quite a lot from it. But the company is essentially splitting itself down. I wouldn't say it's splitting itself in half, but it is cutting a significant chunk of its business out. It's over-the-counter products, it's mouthwash, it's the over-the-counter drugs that it provides, the toothpaste, etc., and it's going to amalgamate that into a different company, along with what Pfizer would provide in terms of the same. So Pfizer and GSK are doing a little bit of a collaboration. They're going to make a company from scratch by divesting their over-the-counter products into a completely different company that they will obviously own significant interest in. But I do believe, in the information that I read, that the company is going to have a different name. I don't know whether it's going to be a mixture of Pfizer and Glaxo. I'm not even going to try and pretend to announce a name that would be like Pfizer SK or whatever it is, a mix up of the two names. I'm sure there'll be somebody paid an awful lot more money than I that can come up with a great little logo and a great name for that company. But they're going to move that all off into one company, retain a significant interest, but it will be separate, and it will have a separate listing, registry to Companies House, and be a completely separate company to all intents and purposes, allowing GSK and Pfizer to concentrate on the big pharma side of things, the vaccines and the drugs that are going to be prescribed to people or treat really bad diseases, not just over the counter at the pharmacy like painkillers, etc. And that wraps our 5 stocks up. I hope you have enjoyed the video. Just a quick recap: the stocks we have covered are GlaxoSmithKline, Legal and General Group, Unilever, BP and Royal Dutch Shell, all paying dividends at the moment. All have a commitment to paying their dividends, at least in the short to medium term. Royal Dutch Shell, I believe, will be, and that's just a belief on my part, will do its absolute utmost to keep paying its dividend. Glaxo paid its dividend recently, and I see no reason why they would not in the future. There isn't much of a risk to them apart from that company merger that I mentioned. Legal and General and BP, they depend on counting the cost of the outbreak afterwards, and BP is dependent on the oil price recovery and people getting out, getting back to work and start using oil even more. And then Unilever, last but not least, is again dependent on just keeping its product line going. People keep cleaning. As we come out, the use of the products may go down slightly, but they should have recovered their balance sheet issues by that point. Just a quick wrap up. GSK has paid its dividend for 14 plus years. Legal and General has done exactly the same and has a growth rate of a couple of % per year. Unilever has paid its dividends for at least 12 years with 3 or 4% growth per year. BP and Shell have both had slow growth rates of their dividends, but have been paid for. Shell has paid its one since the Second World War, and BP has paid its dividend since the Deepwater incident in 2011. It has paid since then, and it paid for a significant period before that. So if BP can survive Deepwater Horizon, I would say it's pretty best place to going forward to weather this health crisis. And that wraps us up, guys. I will see you back in the real world. Welcome back to the real world, guys. Thank you so much for sticking around to the end of the video. I'm glad you had the endurance to do so. That helps me out and it helps the channel out massively with the uptick in viewing time that I'm going to need to get this channel to where it wants to be. Again, one last time, if you could please hit the subscribe button or hit the like button if this video has actually helped you. I hope you enjoyed it. I hope you can see or might even potentially add these 5 stocks to your portfolio if you haven't already. Please do your own research before doing so. I conduct my research, but just because these stocks are right for me and I've invested in them doesn't necessarily mean they're right for you, and you must do your own research first. I can't stress that enough. With that being said, I will catch you in the next video. Catch you later. Bye bye.